What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is November 25th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to talk about the 3 key reasons why I believe we've got a major wave of capitulation coming for crypto markets. I know after all that's gone on with FTX, all the things that we have been through here during this bear market, everyone is hoping that it's over, but I'm going to be real with you guys here and talk about the 3 key things that I've got on my radar that are sending some big red flags. We've got a lot of things to dive into in today's video. If you happen to like it, drop a like. It's one of the best ways you can support the channel. Let's go ahead and kick off the conversation. So first off, I want to talk solely about price action and momentum in previous market leaders. Now, sounds a little bit fancy. What am I talking about? What I'm talking about here is how the previous assets, whether it be assets like Bitcoin and Ethereum, or more traditional assets like technology companies that are still on the forefront of innovation and taking on higher degrees of risk in their business model, they are the ones lagging in this market. Now, if we look back over the last decade, these are the kind of technologies and investments that did phenomenally well. They far outpaced traditional indices like the Dow Jones or the S&P 500, which basket more traditional stocks that are more established. When we see these indicators leading forward, it signals a risk-on period. People are taking on more risk. They're focused less on profitability in the sense of the fundamentals, and are focused on whether or not these ideas can really go out there and build exponential grades of value. And we saw that with things like the FANG stocks. We saw it in a decade secular bull run for Bitcoin, albeit with some major corrections along the way, or what many people might even label bear markets usually for crypto. But I want to go ahead and focus in on the idea that we are at the end of a secular bull market. And we can see this not just from my opinion or take from the lack of momentum we have. That's typical in one of these corrections that we get, right? We do get slowdowns in equities and crypto. But what's different this time is what price is telling us. And I'm going to go ahead and turn off our drawings here and just focus in on the indicators. As something we have highlighted since back in June, as we were focusing on taking advantage of any relief rallies like we did around $24,000 and $25,000 on Bitcoin, we took our crypto out of the market. We sold and went back into cash in August because of the fact that we had had a suspended period of time below the 200-week moving average and the 200-week exponential moving average. These 2 indicators are usually a buy the dip opportunity where price barely remains in this range for very long. If anything, it stays in between this pocket like we saw in 2018 or in 2015, right? And as we can see, we have been suspended below this, continuing to set in lower highs and lower lows for the past couple of months. We've never done this in Bitcoin's history, but it's not just Bitcoin. When we take a step back into the macro picture that many people here on YouTube and the crypto space aren't watching, if we take a look at the performance of the NASDAQ, we can see that the traditional buy the dip opportunity, many times in which price wouldn't even come down and touch that 200-week during the last decade, right? Really the last time we saw this again, where you're trying to teeter and make it support was, well, back in 2008, where we were not able to hold it. We are now treating it as resistance. And every time we come up to those 200-day moving averages, again, usually another kind of buy the dip opportunity during the bull markets, now that is starting to act as resistance. Both indicators on the shorter and longer term time frames are showcasing that the momentum is not there, that the market leaders that were leading yesterday are no longer leading. And it is historically proven that in the vast majority of cycles, you can go back through history. We can look at the dot-com bubble. We can look at the 2008 recession. We can take a look at any major correction where equities pulled back more than 50%. It is likely that once a leader segment like technology stocks, like cryptocurrencies, when those high-risk assets are underperforming and they are below their 200-week and now treating it as resistance, it is a sign that we are about halfway through, that we've got more pain to come until we can start to see rotations in new market leaders. It's not always the case, but in the vast majority, that is the situation. You need to have further capitulation because here are the important dynamics to understand here. If we take a look at the market, we can see that the Dow Jones is giving a completely different picture. It's well above its 200-day moving average. And if we put on our weekly moving averages here just to kind of get a reading, we can see that it only lived below that range for a short period of time. And most people would say here that, isn't this a sign that the bear market is over, Nick? Isn't it a sign that people are going more towards defensive stocks? Well, to be honest, as we focused on previous videos, this is what happens when you're going through a prolonged recession. The defensive stocks have stronger relief rallies because they pay good dividends, they're more stable business models, and they can survive much better in a high interest rate environment. But as we saw back in 2000, we had the same pattern here. Many retests above that 200-day that were nothing more than deviations that went back down. And when they went down below those moving averages, they did exactly what they've been doing time and time again. They set in new lows where price eventually breaks down and continues collapsing further. And this is why, again, I really want to emphasize as we go throughout the video that we're going through a cold winter. We are going through a brutal period of time, not just in the sense of metaphorics when it comes to the market, but really in the grand scheme of things when it comes to energy markets, inflation, all the other things we're going to talk about. But I want to step back again. Take a look at Ethereum. It's not just Bitcoin. We have got the vast majority of these assets that we're leading forward now below their 200 weeks. And until we see a much higher degree of capitulation like we've seen at a minimum, at least in traditional crypto bear markets of over 85%, or roughly around 75% when it comes to Bitcoin, right? Until we see this, we are not going to see a full sustained bull market. It is very unlikely that we are going to see that. And at a minimum, we're going to wait till we see higher lows and higher highs. And we're not seeing that in price. It's not about picking bottoms. It's about knowing when the trend lets you know that it's time to hop on your surfboard and ride the wave. If we're not seeing those signs, we sit patiently in cash. We wait for the right momentum signs to signal. And as you guys probably saw from our Macro Monday special or in our previous episodes, we looked at that market order flow and it's not looking pretty. There's not much bid side support for what we should usually expect at this range, and there's not a lot of market order flow. Next up, we got to talk about inflation, because while the Dow Jones may be looking nice here, as these companies are much more consumer cyclical, they can adapt their pricing to adjust to basically adapt to inflation, whereas technology companies don't have the same flexibility. We need to talk a little bit about what's going on in energy markets and inflation, because this is something that, to be honest, over the past week or so, we haven't talked too much about, but we've really been talking about this for months here. And guys, I gotta tell you all, one thing that slipped past my radar over the past couple days is natural gas. Natural gas has been on a huge rally here, back up to where it was practically back in many periods of time over this past year, back where it was in mid-September, back where it was during August, back where it was even in April of 2022. So natural gas has been remaining suspended here at its highest level in the past month and a half. And on top of that, what we need to be very cautious of is the fact that it seems, whereas many people were starting to think that natural gas would break down and this would be the peak inflation, that instead it is now getting back up into the general ascending channel. Right now it's facing a slight bit of temporary resistance, but if it clears through there and continues climbing, I want to go ahead and just explain a very important dynamic that many people don't know about. This is something that smart money, profitable traders utilize, and it's a concept known as deviations. Now, you all have probably seen me highlight these kind of these red kind of half circles, or these red cups essentially, where we see that when we get up to a certain point here, right, you would think if you're just looking at this chart, a lot of traders would think that if you got price above that 200-day moving average for the Dow Jones, it's time to go long. It's a breakout scenario, right? That's the moment where all the capital is going to rush and we're going to realize the bear market is over. It's time to go long. And that's exactly what all traders do, at least the ones that lose money. And what happens is when all those people are going long, it gives the necessary liquidity for investors, the smart money who need that additional liquidity on the other side of the trade, to go short, and vice versa. Right? When we had the dip down here below the 200-week, you had a lot more people who were panicking, and the institutions took advantage of that, and they had a deviation where we popped right back up above that 200-week, and we went for a nice rally where institutions made a heck of a lot of money off of short squeezing a lot of investors who were getting short way too late. Right? In the short term, right? I'm not saying that there's not room to go down much further, but you get my gist here. These shorter term traders and institutions take advantage of these exacerbations because it gives the spread to be able to make some solid returns in either direction. So that's an important thing to understand. And we can see with natural gas, a lot of people, again, we're starting to bet that we were going to break down here, right? We were going to start to collapse lower, but we got another deviation where we barely tapped that range, and longs, again, the institutional money started to bet here on natural gas. Now, what happens when we have these deviations? What happened when we broke out of the channel here back in February of 2022? And we got back into the channel here. Well, we saw a revisit back up to the line of resistance that's made up of the two previous significant highs. And that took us to new relative highs here for this bull run in commodities, pushing natural gas even higher. Well, if we get that here, the next price point, roughly speaking, that we have for natural gas is somewhere around anywhere from 12 to 13 points on the CFD contracts for natural gas. To put that in perspective, where we were last time for natural gas, for the previous highs, was around 9.8. And if this happens, it is going to be detrimental for the Fed's target of reaching its target of 2% inflation. This will have meant that we have not pushed rates high enough. And we're starting to hear all these talks about pivot, that the market is ready for the Fed to start doing 50 basis point increases or 25 basis point increases, just like one or two more, and then capping it. We are far away from peak inflation if the Fed does that. If the Fed, for a moment, eases up, if they start to signal that, it's going to provide relief to financial markets. That'll put more liquidity in the economy, more money out there in circulation, and it is going to push prices higher. Now, oil is looking a little bit better here. But I want to make it very clear, as we've been talking about on the channel, that oil, since back here in August, has been setting up the framework to test the Fed. It has got the 200-week moving averages widening in here as a range of potential support, and the 200-day moving average. And I want to make it abundantly clear here, there is a reason price has been sitting in this range. It is determined by whether or not the Fed is going to continue leading against inflation, hiking and tightening monetary policy more aggressively than inflation is inflicting on price, or are they going to backtrack? And if they backtrack, I got to tell you guys, oil is going to do its thing. It's going to continue to go up. It is about the Fed determining and showcasing that it is in the lead here. And this, bear in mind, has been able to come down large in part due to the fact that of the U.S. crude oil strategic petroleum reserve. We've talked about this dynamic for months. And I have to tell you all, the current Biden administration diluted a ton of the strategic petroleum reserves. In 1 year, practically, we went through over 1/3 of this. We haven't even gone through a full year, and we've cleared through 1/3 of this entire strategic petroleum reserves. Now, if we want to just keep draining it and play our cards, well, maybe we can win the war in reducing the price of oil and natural gas. We can cool and rein in inflation. But if that gets too low, and countries like Saudi Arabia and other nations within OPEC decide that they want to start cutting production, playing in the international game to keep prices high and inflated, they can do that, and we will be caught with our pants down, because you can't just spring up new oil and natural gas pipelines or new oil and natural gas discovery projects in the United States or in Canada and other regions. It takes years to do this. And the companies are not showing any major urgency to do that. And that is exactly why futures have remained elevated. I've talked to a lot of people who work in these industries, and they're very concerned that oil and natural gas are going to remain either suspended or likely to move back into an uptrend here. It's why these have been the leading stocks in the market, folks. If you look at oil and natural gas, they are the market leaders. They're the only major sector outside of pharmaceuticals and healthcare that are starting to lead during this bear market, some of which are setting a new highs and new lows. And that's the only kind of things that we're looking at investing in. We made a call, for example, in the Dash report back this past month for November. And in less than a month, one of our pharmaceutical stocks that we wrote about is up over 120% from our entry. And that's the kind of stuff that you see during a bear market. You see which sectors are starting to lead. And that's one of many calls we make in the newsletter. The other ones we've been doing are in energy. One of them's up about 15%. The other one's slightly above break even. So we've generally got some really good plays because we know what to look for. And we know the dynamics here. And it's not just energy. You got more kind of boring industries here like corn futures, still way higher than the lows back in July. We should be seeing this kind of price action if the Fed is doing the right thing. We need to see a major significant oversupply and reduction of demand, because the supply side is where things are difficult right now. We have a broken supply chain. So you need to get demand cooled down. You need to stop the excess spending. You need to get that excess money out of the system. Same goes here as well for copper futures. We've got a major spike here, still setting in higher lows and higher highs, generally speaking, since back in July. The Fed's tightening is not enough just yet. And to top it all off, as we finish up the first major topic here, the VIX, the volatility index, while it has been declining here, I want to make it very clear, as we have seen time and time again, that the VIX has been setting in consistent resistance points and is set in higher lows every time. This is where, to be completely honest with you all, I'm looking at shorting. Not crypto so much, but equities. They're put options. They're just simply 1x shorting stocks, not getting too crazy. This is where I would feel a bit comfortable with that. I'm not saying that you guys need to do that, but for me, when the VIX gets down and when volatility has weakened, but is still holding at a higher level than the prior one, the trend is still intact. And even if it comes down here to the same level as the prior one, it doesn't mean that that's a clear sign the bull market is on and the bear market's over. Volatility is still heavily suspended. Take a look as we zoom out here. We're really talking about over 5 years here. We are building up for a major capitulation event, something that is going to push us up into the stratosphere of volatility, similar to that of March 2020 or back in 2008. The market is calling for it here. And people aren't listening. People aren't watching for it. But we are here in this channel because we want to be prepared. We want to make money during this period of time. And we want to come out swinging when it is time to go along with the bull market. Now, next up, we got to talk about some of the major crypto fundamentals. So we talked a bit about the price action in crypto. We talked about the macro sentiment. This is the third major dynamic here that is important to know. And we're going to dive into our partner dashboard on CryptoQuant, which you guys can access for free down below in the description. Register for an account. It's free. There's no cost to it. Just go ahead and use it. I think it's one of the many tools you should have in your arsenal if you guys want to get an understanding of on-chain metrics and analytics, as well as some market data. And there's really some interesting charts that I think play into our conversation here today. So first up, I want to talk a little bit about the supply and profit SMA 30. This is a custom indicator that we track here on the platform. And if we just simply zoom out here throughout history, we can see that traditional bear markets, just traditional crypto bear markets, which I'm almost labeling as corrections here. I don't think we've been through a real painful recessionary bear market for crypto. We just haven't been since 2008, and crypto only started trading since 2011, right? The typical corrections, right, as we see within crypto, those 85% plus corrections usually take us down to an SMA level of around 45 points, right? We usually can sometimes go a little bit lower, like 44, 43 on the yellow band. As we go throughout the chart, you can see it here where I take my mouse, right? We usually get down to that low 40-point range in practically every bear market. But right now, the lows that we've set in here are 51.3. Now, I want to ask you all here, for those of you who maybe were here during the 2018 bear market, maybe this is your first crypto bear market. I know we got a lot of people here, and there's nothing shameful about that. Everyone's got to go through their own bear market. I've been through many, and it's always painful, yes. And I made many mistakes along the way, right? But the important thing is to learn from them and ask yourself the question, now that we've got the macro sentiment that we have, is it possible that we're going to set a higher low on this moving average? I can tell you guys back in 2018, I'm sure there was macro concerns to some degree. There was a tiny correctionary period in the secular bull market in 2018, but we didn't have the highest inflation in over 50 years. We didn't have a war going on. We didn't have a global disruption in the supply chain. China was still chugging away and producing the goods and services that we needed. Everything was predictable. Globalization at its peak. Now, we've got a very different environment. And it's an environment where the Fed is tightening. It is not easing monetary policy. And the global supply chain is not helping to budge and producing that excess supply that we need to meet the excess demand. And that is going to crush sentiment to invest in crypto. It is going to probably push us to new lows on this indicator. Let's take a look at another one, the Korean Premium Index. As we talked about and what we write about in the dashboard is that the Korean Premium Index, while it might sound good when the Korean Premium Index is up, it is a sign that the speculators, those who are constantly just buying the dip every single time, hoping that it's the end of the bear market, are now paying a premium, which is a foolish sign in the market. It is a sign that people are taking excessive risk. It's just like what happened back here, right? Many people thought the dip here in May, right? We talked about it. We were simply a little bit too caught off guard by it as well. We thought 30K was that level that was going to hold, and it was going to start off the next wave of the cycle. Well, we should have looked back at the Korean Premium Index, which spiked up here and should have been our instant signal that we've got more capitulation coming. It happened here as well when we dipped down in December of 2021, right? We see it every single time until we get a sustained one, right? That comes much later on in a bull market. We are still in a bear market. Last but not least here in the data science models, we got to talk about the MVRV, the Poile multiple, my apologies, sometimes get them mixed up, which is, again, tracking whether or not miners are making more money than they have over the last 365 days. Right? It's giving us a general estimate of the payout ratio from mining rewards versus what you would have gotten over the last 365 days. And we see generally that when we're at the peak of bull markets, we get up in this range, and when we come down here, we're nearing potential end of a bear market. We have not seen a flash sale down here towards the lower of the green, lower part of the green band. And that is what we need to see. We need to see minor capitulation. There's still too much hash rate going on in the Bitcoin community right now. And while I think that's awesome, fundamentally long-term, to have that hash rate to secure the network, it is at a complete disproportion from price. And mathematically, there is going to need to be capitulation to some degree unless Bitcoin can really start to rally higher. And usually in just the normal typical bear markets, we see this kind of pullback. We have yet to see it just yet. We've completed most of it, but we need to have a capitulation wave that cleans out the sector and puts us in a position where price is low enough, where miners have to shut down, and it generally gives us an opportunity where the sector can start to rebuild. New investors come in, they buy up those assets and start to take on exposure to the industry. So that's an important thing here. The data science models all across the board. I can't find one model, even the NUPL, one of my favorite ones, the net unrealized profit or loss. All of this is looking really bad for crypto here. If we take a look on the zoom out here on the net unrealized profit or loss, as we talked about, while it was always setting in higher lows here as we were going through a secular bull market for a decade, we've now sit in a lower level than the March levels, which means that we're likely going towards the lower end of the blue capitulation spectrum here on the net unrealized profit or loss. So that's the data science. And on top of that, to play into it, we've got 10,000 BTC moving off of a crypto wallet linked to the Mt. Gox hack. Now, bear in mind, this is 10,000 Bitcoin that was hacked from Mt. Gox. This was the exchange hack way back in 2013, 2014. And unfortunately, this is not even 10,000 Bitcoin from the creditors that are still going to eventually get paid out in 2023 in Q1. So we've got 10,000 BTC that are going to probably add sell side pressure. They already started to move some of those to some different Bitcoin exchanges. I think they had moved over around like 800. So they're going to continue to sell these. They're going to continue to unload. And that's on top of the fears here around the creditors finally getting their Bitcoin from Mt. Gox. Over 140,000 Bitcoin could be likely entering into the market over the next coming months. And I can tell you all, that's not going to add any buy-side pressure. If anything, it's going to add sell-side pressure because people might want to sell those positions. And that's on top of further contagion from FTX, further contagion from Genesis, further contagion from Celsius, further contagion of Voyager, BlockFi, all these players. And we think that institutions want to come into the sector now, that they're just going to buy the dip. Oh no. They're going to wait for much higher degrees of capitulation. I can tell you all that here today. Institutions need that market sell side pressure to get major orders filled. And the way that Bitcoin's price is sitting now, again, just trying to kind of push sideways here, like we did back in August, trying to form some kind of capitulation period, right? Maybe there's some temporary buyers now. But folks, this is not how a bottom typically looks in crypto. Now, there's one big important dynamic we got to talk about here. And I want to lead into talking a little bit about the altcoin market and Ethereum. We have yet to see, there's a little bit of a bonus here on our three things that we're watching. This goes back, I guess, into a bit of crypto. We are at a point right now where when we look at altcoin dominance, it still, to me, looks very clear that the market has not woken up yet. And this is the Bitcoin, ETH, USDC, USDT dominance. It measures how much the leading stablecoins and the leading cryptos make up in regards to the market valuation. And they make up about 72.5%, roughly speaking. They've been in this little pocket between the 200-week and the 200-day for a long period of time. I got to tell you all, I mean, if we look at just the previous bear market, right, or even just periods throughout actually upticks in the market, right, in December of 2020, that metric was much higher. Much, much higher. Which means we've got a ways to go before altcoins are going to be the solid bet to play. And this is why I've really emphasized here a lot on the channel, not so much focusing on price action, right, and trying to buy every single dip, but rather having the patience to be able to focus on researching which plays are going to be the winners when it's the time to get in on altcoins, to get in on the new applications, and get really excited about the next wave in the next bull market. And for me, there are really two major focuses that are important for me. Either projects that are going out there and building something entirely new that's really exciting and groundbreaking and could add a lot of value, or those who are building applications on top of pre-existing industries out there in the world, improving them through the means of decentralization. And that's exactly where our sponsor for today's video, BetDex, comes into play. Now, for those of you who haven't heard about BetDex just yet, it's aiming to disrupt the multi-billion-dollar sports betting market that already exists here today. And while I'll admit I'm not an absolute sports pro by any means, I've played a lot of sports throughout my life, and I understand the concepts of the sports betting markets due to the fact that I have a lot of family members and friends who are really interested in the topic. But I've also heard a lot about the inefficiencies that can come with centralized platforms, from high markups to also not having the flexibility to set the types of bets that you want. And I think this is where decentralization, bringing it more towards a peer-to-peer nature, brings it into a very exciting format for sports betting as a whole. So I want to spend some time to dive into the platform, talk a little bit about it, but also some of the major accolades, like the fact that it's co-founded by Nigel Eccles, who's the founder of FanDuel, one of the biggest sports betting platforms out there. So there's a lot of things riding in here when it comes to BetDex as a platform. Now, one big thing that you should know about is that before you guys decide to participate in the platform, know that you guys can get a free $5 airdrop of tokens to place some bets on different games. It's the World Cup now, so it's a really exciting time to test out a platform like BetDex, and you guys can get $5 worth of free tokens, risk-free, where you guys can go out there and place bets and just try out the protocol first. I always recommend that that's a good step to do, especially when you get a free entry like that, just to try it out and be an early adopter on a protocol. But let's go ahead and dive a little bit into the user experience. Now, right now, we don't have any games posted out just yet for the upcoming games, but I want to go through in one of the previous games and just showcase the previous user experience of how you go through and actually bet on a game. And the one game we're going to be looking at here is between Brazil and Serbia, two countries that are close to me, as I've been to both countries before, and I think is a really interesting matchup. So when we talk about the user experience, there's a couple key dynamics here. We've got the price chart, which will showcase over time here on the sports betting. We've got our major offer queues here where we can basically go through and set a back offer or lay offer. I'll explain a little bit about the dynamic there. And also as well, we can go through and choose whether or not we want to bet specifically on Brazil, on a draw, or Serbia. And we've also got our trade prices here. Now, the big thing that I want to emphasize on this here is when we place in an offer. And once we've got our wallet connected, we've got, in this case, we've got some tokens here that we can stake up. We get to essentially either set a back offer or a lay offer. Now, when we're backing something, we're essentially backing the idea, in this case of Brazil, that they're going to win. And what's really nice about this is we can set in a custom odds level to see if other participants will want to match to our offer and bet against it. So we can, for example, put in a stake. I've got a good amount of tokens here, but I'm just going to go ahead, put in my 5 BET tokens, free ones you got here. And on top of that, we're going to go ahead and set in the odds at 2. So essentially speaking, if I'm placing in backing odds here and I'm putting up a stake of 5, I have an opportunity to make 5 additional bet tokens to double my money essentially. Now again, I always like to play lighter odds here. I usually, if I were to ever do sports betting, I would usually do things like 1.25. It really depends though on the game that we're going on and what kind of teams we're betting on. But essentially speaking, you guys get to customize those odds, how much you want to put at stake, and simply place the order on chain. And what's really cool about it is that you know the risk that you're stepping into up front here by setting in the predefined risk profile that you have on your positions. So again, I always recommend keep it moderate. I think it's something as well that can keep us really excited around the World Cup. It's a pretty exciting world event. I love these kind of global events for people to come together. And it's something where, again, with family members and friends, you guys can get creative with it. And it's decentralized, which I think is really exciting. So if you guys are interested, they're going to have fee-free trading for the rest of the year. So if you guys want to participate, there's no protocol fees. And on top of that as well, it's going to offer you the ability to be able to bet on some of the more exciting games here during the World Cup. So feel free to check out the link down below in the description if you guys are interested to test it out. But above all, this is why I'm keeping it on my radar here for the next bull run. I'm really excited to see these kind of protocols that are building during the bear market more than ever and really have exciting use cases. Now, last but not least, I want to close off here, guys, when it comes to the topic of Ethereum. Right, going back on this topic of altcoins, again, it's not about just buying every single dip. It's about finding the key signs when we've had capitulation. And when that capitulation comes, immediately knowing which plays out there are going to be exciting. Plays like that DEX, right, that we talked about here today. And I got to tell you all, again, when we look at Ethereum's price, I want to just go ahead and turn off our drawings here. We've got our moving averages. Do you all feel we've hit capitulation yet? I don't think so. And I'm not saying Ethereum needs to go down to the previous ETH to BTC ratio lows. I'm not saying it needs to go down all the way to this low, right? We've generally set higher lows here for Ethereum against Bitcoin. But I gotta tell you all, until we get down to those 200-week moving averages, I think we are far away from any bottom in the market. And for now, what we got to do is look for the different signs going on, talk about the macro developments, and on top of that, focus on the projects that are doing really exciting things. We've talked about a lot of them here on this channel, and we're going to continue to talk about other projects as we go throughout the next coming months. But anyways, if you enjoyed this video, consider dropping a like, consider subscribing if you haven't already. Leave a comment down below on your thoughts on what we talked about here today from the key 3 things that we're watching. But until the next video, everyone, thank you all so much for watching, and I'll see you all in the next one. Take care, everyone.